Hello everyone and welcome to this webinar from Employee Ownership Australia's Experts Panel. For those who don't know me, my name is Jess Mitchell and I'm a board director for EOA as well as an employee equity consultant for Tapestry Compliance. Before we get started, I would like to acknowledge the traditional custodians of all the lands that we're meeting on today. For me, that is the Turrbal and Yugara peoples, and for our presenters, Natalia Gordin and Sonia Kew, it is the Gadigal people of the Eora Nation. We pay our respect to elders past and present, and we extend that respect to any Aboriginal and Torres Strait Islander peoples joining us today. I'm really excited about this webinar because it's an overview of a very important topic for us in the employee ownership industry, which is equity plans used by unlisted or private companies. Our presenters, Sonia and Natalia, are both bringing a wealth of experience and technical expertise. I'll hand over to them in a moment, but before I do, I just wanted to share some of the other events and developments that EOA has in the pipeline. First, we're moving back to a monthly webinar schedule, and in December, we'll be holding a webinar on the essentials of offering your share plan overseas. Early next year, we'll be presenting on EOA's reform agenda, which includes some major legislative and regulatory changes. We have some very ambitious goals, which include a long overdue update of Australia's tax beneficial plans with the aim of making them more attractive to employees and useful for companies. Reducing the compliance burden on companies offering share plans generally, and on a different track, making employee ownership a viable succession model for smaller businesses, as it is already in other major jurisdictions. We're also going to present a summary of a lot of new data and research around employee share plans in Australia. And then before reporting season in 2026, we'll be looking at state payroll tax and other practical issues. We are very open to feedback from EOA members and the industry on how we're engaging in the content that we provide. So if there's anything else that you'd like to see or you'd like to be involved in, then please get in touch with us. Finally, we are also keen to hold more in-person events in 2026 because it's always best to connect in person when we can, so we will share more details of that when we can. I'll now hand over to Sonia and Natalia for their webinar on equity plan structures for private companies. Thank you.
Thanks, Jessica. Just a quick introduction from us both. So I'm Sonia Kew. I'm a member of the EOA Experts Panel, and I also sit on the board. I'm also a director at PwC in the Reward Advisory Services team, and I'll also hand over to Natalia to give a quick introduction also.
Hi all, my name's Natalia. Apologies for the croaky voice today. I am also a member on the Technical Experts Panel at EOA, and I sit on the board, and I'm a senior manager in EY's reward team. Sonia?
Great. Thanks, Jessica. So just a quick run through the agenda. We'll just flick screens, great. We'll start by discussing the key reasons why private companies implement employee share schemes. Next, we'll cover market value options, including an overview and considerations there. We'll then explain the concept of premium priced options and what that means for both company and employees. After that, we'll look at the startup concession and the benefits there. We'll also explore share rights. We'll explain loan shares, how they work and the benefits. And finally, we'll go through the steps for implementing an employee share plan effectively. We can take questions you have anytime through the chat function on your screen. And we'll also have a dedicated time at the end of this session for any questions also. So why operate an employee share plan for a private company? At its core, an employee share scheme is a way for employees to own shares in the company that they work for, aligning their success with the company's success. This is especially valuable in private companies where ownership is more closely held and less liquid than in public companies. One of the main reasons to operate a share plan is to incentivize employees. Instead of just receiving a salary, employees get a stake in the business. The ownership motivates employees and they work harder and smarter because they directly benefit if the company does well. It turns a job into essentially a partnership. Their efforts can increase the value of their shares, which creates a strong incentive to contribute to the company's growth and success. Employee share plans also serve as a powerful retention tool. Many share plans include vesting schedules, meaning employees earn their shares gradually over time. And this encourages employees to stay with the company longer to fulfill the benefit from the share plan. It reduces turnover, and that's proven, and the associated costs of hiring and training new staff, which is especially important for private companies looking to maintain that continuity and preserve institutional knowledge. Another key benefit is that employees get to share in the company's growth. When the company succeeds, whether through increased profitability, expansion, or eventually a sale or IPO, the value of the employee share rises. This can translate into significant financial gains for employees, making them personally connected and invested in the company's future. It helps create that shared sense of purpose and aligns employee interests with those of owners and management. Finally, an employee share plan makes it easier for employees to become shareholders. Without a formal plan, it can be complicated or costly for employees in a private company to buy shares and participate in ownership. Share plans essentially simplify this process by structuring how shares or options are granted, managed, and sometimes bought back. This ensures the process is fair, transparent, and legally compliant, making employee ownership accessible.
Should we go to the next one? Sorry.
Yeah.
Thanks, Sonia. Right, so I'm going to start going through some of the different types of equity incentives and how we might structure those. As you can see, I'm going to start with market value options. Just a few high-level comments before we get into what these actually look like in practice. So coming off the back of all those great points that Sonia's just made around why you might operate an equity incentive plan in an unlisted company, we also need to think about how would we structure such a plan. And as we go into these, we'll talk about what the structures look like. Things to think about are the different award structures will impact what the award looks like up front, but also how the value is realized over the time of the plan and how the value is delivered to employees and how much value is actually delivered. Um, it's also important to think about things like when do we want to, like what are our time horizons? When do we want to deliver value and why do we want to deliver that value? So things like, do we have a business that's really just geared towards an exit and we don't want to give any value out until such time as we get to our exit, whether that be a sale or an IPO, however we want to define that. So we're all geared towards that. Or do we actually have a business that maybe we'll sell, maybe we won't, but we really just want to encourage some long-term shareholding, some access to dividends, some real ownership mindset in our key employees and executives, not necessarily geared towards an exit, or that's not the only thing that could happen. But we do have our own performance metrics for the company for our employees that we want to incentivize them to work towards. So these are sorts of things to think about as well. And having that real link towards with the nature of the business, where that business is going, and what we want to move towards is a really great way to explain and to shape up these equity incentives. Another point to make is that equity, a lot of companies, particularly startup companies, will find themselves looking for key talent, specifically where you see there might be a gap in terms of your knowledge base. And hiring or getting that key talent on board can be quite expensive. And there isn't always a lot of cash flow or cash reserves to pay the kind of either salary or to give the bonus opportunity that some of those individuals would want. And so to give equity to those sorts of employees as a way to sort of top up what you can afford to pay in cash is also another great way to form part of that package and part of that incentive package. And also allows them to then, really links that employee up into that business plan or wherever that business is headed. And then the other point was around just really giving employees an opportunity to acquire shares where you otherwise wouldn't be able to for an unlisted company. So where employees work in a listed company, whether through their employer or externally, you can get a hold of those shares through the usual, whether it's ASX or wherever the shares are traded. That's not the case for an unlisted company. So it does give people an opportunity to acquire equity where they otherwise wouldn't have. So that's just a few things there. So we thought we'd start with options and particular market value options, because this is quite a common arrangement, and fairly common in the market, and also just a very sort of, I suppose, well-known, well-trodden structure for equity incentives. So I'm just going straight back to basics. What is an option? So an option is a right to acquire a share. So one option, typically we see in Australia, is one option is a right to acquire one share. But you don't get the right to acquire the share until certain conditions, what we often call vesting conditions, are met. And those conditions can be time-based, so you've got to stay employed with us for 3 years. They can also add things like individual performance KPIs, performance metrics of the company, those sorts of things. So there's an option, and if you meet all the conditions, each option can give you the right to acquire a share. Why they're called market value options? So market value options, to acquire your share, you have to exercise your option. And for a market value option, you have to pay an exercise price that's equal to the market value of the shares on the day that the option was originally granted, so on day one. What that does economically is it rewards for share price growth. Because you're paying for your shares, essentially by paying the exercise price, you're buying your shares at the share price on the day that the option was given to you. Any increase above that is the value that the option will deliver. So that's important to note, because if the share price does not increase, or if your share price in fact decreases, which is what we call options being underwater, there's no value delivered, because you wouldn't be buying shares above what their market value is. That's not a good deal. And so when we're thinking about using market value options as a structure, it really is for a company where we're really looking to incentivize for that share price growth. We're expecting share price growth, and we acknowledge that if the share price growth doesn't happen, or happens only minimally, the options are going to either deliver a small amount of value or potentially no value. So it's a real push to share price growth. And so sometimes you will see that the vesting conditions might just be service. You've just got to stay employed up until when we say that vesting event has occurred. So whether that's time-based or an exit event, and then we won't put in those other additional, say, performance metrics of the company, because we're already just incentivizing for that share price growth. So that's one thing. And the other thing to say is, with the tax treatment, it'll generally, what happens is you exercise your options, you pay the exercise price, you get your shares, you will be subject to income tax on the shares that you receive. In terms of funding that exercise price, especially if you're granting a larger number of options, that could be a significant price to finance to be able to exercise your options. And there is the opportunity, often companies will give the opportunity to do something which is called net settlement. So to net settle your options, rather than having to fund the exercise price themselves, the employees, you cannot pay the exercise price, but you receive a fewer number of shares in exchange for the exercise of your options. So you're essentially paying for the exercise price through those shares by getting fewer number of shares equal to what that price would be. That is quite a popular approach, because it just removes the requirement for employees to have to fund that exercise price themselves. And it also means that actually, from a company perspective, you have less dilution, because you're giving out a fewer number of shares, with some of them being held back to pay that exercise price. So we do see that being quite common. Usually when you structure options for net settlement, you give people a choice. So if you do have a senior executive, say, who has got the funds to pay the exercise price and just really wants to get their hands on as many shares as they can, because they think the shares are doing super well, I want to, really invest in the company, then they can just pay the cash and get one share for each option exercised. So that's just a way to give people that that choice where you've got funding required for exercise. So that is our market value options. So I think we'll just move on. I was just having a look. I don't see questions so far, but if someone sees questions and I'm not seeing them, somebody please let me know. So when I talked about market value options, they are subject to income tax when you get the shares. But there are other different tax treatments depending on how we structure them. So I'm just going to move across now, take this back to Sonia for premium priced options.
Thanks, Natalia. So Natalia's covered our market value options, which essentially at the crux, you've got an exercise price that's at market value on the date that those options are granted. So premium priced options have an exercise price that's set significantly higher than the share price as at the date that those options are granted. And there's commercial reasons for why these are done, and normally they are done for medium or high growth companies, and normally we see this in the tech industry and other high growth scenarios. There is a tax benefit to that, which I'll cover at the end of this slide. But essentially, it's structured in a very similar way in that employees only gain value if the share price rises, in this case, above the premium exercise price that's set, effectively rewarding those individuals for helping grow the company beyond that initial level. They typically vest over time and based on performance milestones, and effectively they align employee interests with company success. As I said, it should only be used for companies that are expecting high growth in the medium to long term, and that's effectively because you need a financial benefit in order to get the gain. So you don't want an exit whereby these options are left underwater because of the premium added to the exercise price. From a tax perspective in Australia, if they're properly structured, usually tax is deferred until the time of an exit. And at that point in time, there's a capital gains tax benefit as opposed to income tax on exit. I think we'll move up to the startup options now, Natalia.
Right, so there are some startup options. These are options that they're called startup options under the tax legislation. They're essentially what startup options are is they're essentially market value options, similar to what I described just previously. But they have tax concessions, which is that if you properly structure them to align with the requirements of the tax legislation, you pay capital gains tax when you sell the shares and not subject to income tax. So it is a good tax outcome in that respect. Startup options, as their name sort of suggests, is a tax concession available to what the ATO considers to be a startup company. So it's to help out small and growing companies. And, for all the reasons that I discussed before around, trying to incentivize employees, but also trying to give employees some equity where, to bump up the overall pay package. In order to qualify as a startup option, to qualify to grant startup options, the company itself and the company's group needs to meet certain requirements. The offer needs to meet certain requirements, and the employee needs to meet certain requirements. We're not going to go through these in exhaustive details, but just to give you an idea, essentially what these requirements are trying to do is it's a small company, newish, unlisted, and then some requirements around the offers. So you mustn't be a publicly listed company, and the company's group must have been incorporated for less than 10 years at the date that you grant the options. The aggregated turnover of the company, including its group, mustn't be more than $50 million, and the employing entity for the employees receiving the startup options must be Australian tax residents. So newish company, less than 10 years incorporated, aggregated turnover no more than 50 million. The offer itself has a few requirements. They're not too different to how you might structure market value options generally. So the options do need to be over ordinary shares. They can be a different class of shares, but we can't have things like preference shares. It's going to be sort of straight up ordinary shares. You've got to hold the options or the shares underlying the options for at least 3 years before you sell them to get your CGT, capital gains tax treatment. So that normally looks like in practice is there'll be disposal restrictions on those options for 3 years, but you generally have a vesting period of at least 3 years on those options. So remembering that the vesting period is that time up until the options become exercisable. And that tends to take care of the 3-year requirement. There are some exceptions to that. For example, if someone ceases employment or if you have 100% takeover of the company. The exercise price has to be set at no less than market value. And the employee who's receiving the options mustn't hold more than 10% of the issued share capital at the time they get those startup options. Important to think about, especially with the 10% rule, but also the other company considerations, is that often if you grant startup options and you meet all your requirements and everything's fine, is that you can use that documentation to make further grants of options either on a yearly basis or as you bring new employees in. It's really important to double check or to keep back and checking that you're still ticking off all those requirements every time you grant the options. Things that often trip up people is the 10% of issued share capital. It sounds like a lot, but for a smaller company, you may get some senior executives who's had a few rounds of options being granted to them getting close to that 10%. It doesn't mean you can't give them options, but they're no longer considered startup options with the straight CGT treatment. And so it's important to know that because there will be a different tax treatment when the shares are received on exercise of those options. Again, things like company kind of been incorporated for more than 10 years, that may be the case when you start, but if you say are granting the options and you're 8 years into the 8 years incorporated, then you know you've only got a couple of years left before you can to grant the startup option. So again, it's things like that just to keep checking every time, because you may fall under these when you first set up the option plan, but not later, and you're going to have different tax outcomes. Essentially, the ATO would just consider them not to be startup options and to be subject to tax as if they were market value options. So you just want to be clear, both for the company and for the employees, what the tax outcomes are for those. So that's what I would say about those. But if you do qualify, they are a great way to get that CGT treatment for the options if you're a startup. So moving on to share rights. Share rights are a bit simpler than options because they don't have an exercise price. So you get share rights allow you to get, or sometimes they're just called rights, purchase rights. They allow you to get shares for free. The structure of a share right is, okay, one right will allow you to get one share once you've met vesting conditions, similarly to what I've discussed previously. It could be in 3 years' time if you're still employed. Because we don't have an exercise price and you get them for free, you're more likely to see under the vesting conditions in the rights some performance metrics for the company to have achieved, or individual KPIs for executives, or a combination to meet vesting conditions. So you don't pay anything with respect to get your shares. And so the way it works is once vesting has occurred, so you've got, say, a 3-year vesting period, however long, we test and see if the vesting conditions have been met. They'll often be either like an automatic exercise or an automatic conversion to shares on vesting, which means the employee doesn't need to do anything. They'll just get either the full number of shares or potentially a prorated down number of shares. If, for example, vesting conditions were, I don't know, 80% met, you might have 80% vesting, for example, and they do nothing and then they get the shares. Or you could have an exercise period, but there wouldn't be an exercise price. That allows, if properly structured, for employees to exercise their rights later on and receive their shares a year or two down the track, depending on how long you want to make that exercise period. But to say there is, you don't become a shareholder until you exercise your rights and get your shares. So for so long as you're in that exercise period, there'll be no rights to dividends, no voting rights, really no shareholder rights. What it can do when properly structured is push out that tax liability until the year that the share rights are exercised and you get your shares. Rights, the shares you receive on exercise of rights are subject to income tax. So people could potentially delay that if you had an exercise period. But you still receive full value of shares on exercise of rights, which means that even if the share price decreases, unlike the options we've just been discussing, you will still get some value. So long as the share price is above zero, you'll get some shares for free. It's obviously nicer if the share price has increased, but even if it's decreased, you will get the value so long as you've met the vesting conditions and received your shares. So they potentially could have greater dilutionary impact because unlike, for example, the net settlement that I talked about with market value options, where you might give people a fewer number of shares because they're net settling their options to pay to settle that exercise price, with the rights, so long as they all vest, they'll all convert to shares and you'll get one share for every vested right. I think that's all to say about rights. Rights are, because they're for free, they are the simpler one, but as you can see, we don't get that CGT treatment. They can be simpler to communicate, but it depends what we want to incentivize for. If we're really going for share price growth, they don't tend to really incentivize as strongly for share price growth because you do get your rights regardless of whether the share price goes up or down, but they can incentivize for other things. So you can put in the vesting conditions, other business company objectives, individual, however you want to do those vesting conditions. So they will incentivize towards meeting whatever the vesting conditions are. They won't be as heavily geared towards just getting that share price growth. Okay, so we're going to move over to the very fun loan shares. Sonia.
Great, thanks, Natalia. So essentially, share rights, Natalia explained, they're quite simple, commonly used, and now we're jumping into loan shares, which effectively are quite complex in relation to the structure. We've got a separate webinar that we will do around loan shares. They are quite popular, especially for private companies that are private equity backed. And so it does probably deserve an entire half an hour to 1 hour on its own, but we thought we'd give you a quick rundown of loan shares, given they are quite popular. Essentially, these have the benefit of being treated as capital as opposed to income for tax purposes. And so, what essentially are loan shares? They are shares granted upfront to employees. So at grant, rather than receiving a right or option over shares, individuals are actually receiving a share. And so they receive that at market value, and they receive that by way of a loan from the company in order to fund that actual market value. The loan is typically interest-free and limited recourse, meaning that the employee doesn't have to pay interest and the liability is generally capped to the value of the shares. The loan is then repaid when the employee realizes value from those loan shares. Essentially, the economics for the employee in respect of loan shares are the same as your market value option. So the upside is exactly the same as the employee sees it. The tax is obviously different. They deliver value primarily where there's growth over that market value at grant. So if the company performs well and the share price increases, the employee benefits from that upside. Additionally, employees, because they hold a share, they've got access to shareholder rights, such as dividend rights. And that's a real benefit for employees and a key advantage to holding these. The tax treatment, as I said, is quite favourable. The employee is typically subject to capital gains tax on the gain when the shares are effectively or eventually sold. However, there are some considerations to keep in mind. And so the loan shares, as I said, are quite complex to administer and to explain to individuals. So companies need to be prepared to handle the complexity and clearly communicate these with their employees. There's a lot of research done in respect of what do the employees value in regards to the awards that they effectively receive. And effectively, the value, it's more valuable to individuals to the extent that they understand effectively what they have. And so clear communication is of critical importance. Also, the arrangements are generally not suitable for employees that are already shareholders in the company, and they're also not suitable for employees that are outside Australia because of the legal and tax differences there. So effectively, much of the time with loan shares, there might also be another type of structure such as share rights or another way to incentivize those that might hold shares in the company. And effectively, those there are tax considerations that need to be worked through before loan shares are put in place. I think we can probably move to the next
Move to the
slide.
next one. I think it's one thing is the only structure that we've talked about. I mean, there are other structures that allows that upfront share ownership, which I think some employers do like. So you get to be a shareholder from day one, unlike the other ones that we talked about, which is you've got to wait for vesting before you get your shares. But yes, they can be quite complex, which is why the full remit of all the terms will be probably subject to a separate seminar on its own. Um, so the last bit we wanted to talk about, sort of whiz through our sections, is around preparing for implementation. So we've talked about, and I mean, we could do separate seminars on each of these, but we have talked about how might we structure an employee chapter? What are the equity incentive plan? What are the common structures that we're seeing, and how do they work? But once we've decided on what we think might be a suitable structure, what are other things that we need to think about? And so I'm just going to go, without going through these in exhaustive detail, the way I like to think about them from a high level perspective is sort of what are the purpose of each of these, what's it trying to do, and what do we need them for? So I suppose one of them is fairly obvious is we do need some plan documentation in place. And what that would look like is that those are the terms under which you're going to be granting the options or the rights, whatever the award's going to be, or the loan shares. And it is all contractual documentation. So it has to be setting out all of the terms under which you're going to grant these awards. Generally, what we'll see is there will be a set of what we call plan rules, which will have the overriding framework under which options, rights, loan shares would be granted, and then individual letters to participants, which would be individualized with the name, for example, how many options someone's getting in that a specific offer, what the exercise price of those options might be. So all those kind of per offer, per employee details would then come in a separate letter. Really important to have the terms really set out really clearly in that plan documentation, because that is essentially the contract or the deal that you have between the company and the employee around when they're going to get their shares, and on what basis, and on what terms, and what happens if this and what happens if that. So things like what happens if someone leaves? Do we want to say if you leave, you lose everything? Or are we going to allow some what we call good leaver provisions, for example? So if you leave due to ill health or due to redundancy or certain reasons, we might allow you to keep some of those awards. It's something that you need to think about up front, not when somebody leaves, but actually have these in the terms. Do generally include some board discretion in the terms of the documentation to allow the company to look at things on a case-by-case basis and not draft itself too tightly into the terms, but you want to have an understanding of what's likely to happen, also to protect the company in terms of what might happen at that time or what the expectations are. We talked about exits, also could be just a change of control, corporate events, things like that, other things that the plan documentation will talk about what will happen. So if we are going for an exit, or either, as I explained, the companies that are just really heavily geared towards an exit, or even if an exit might occur, whether that's in the business plan or not, what's going to happen? Are we going to allow full vesting? Are we going to allow partial? How might the board exercise that kind of discretion in terms of what's going to happen? And so all those sorts of things need to be kind of determined and set out in that plan documentation so that we all are very clear on the terms. Rolling up with that is the tax and legal advice. So we did touch on the high-level tax treatment for the awards. It's important to be clear for tax on the employer and the employee tax treatment, because that will go towards, firstly, the employer tax and obligations. We had our previous EOA seminar was on employee share scheme reporting, so it's important as an employer to know what sort of obligations they may have. But also the employee tax treatment goes towards how value is delivered and how employees might actually see value as well. And so some companies will provide a sort of a general employee tax summary. Many companies will to employees, which is not individual tax advice, but it gives an employees a sort of a base understanding of what that tax treatment's going to be, which they can then take to their accountant or tax advisors to finalize, and also their obligations around tax reporting, that sort of thing. And again, it helps them to determine what kind of value they could be receiving under that award. Legals are really a lot about compliance. So we could do a whole section on this, but I think conceptually the things to have in mind is in Australia and a lot of overseas places as well, if you're offering shares, which could include rights to shares, such as options or rights, to anyone, that offer really needs to be accompanied by a disclosure document or a prospectus or something like that, unless an exemption applies. And for employee share schemes, there are certain exemptions under the Corporations Act in Australia that allow companies to make offers under employee share schemes and not have to comply with any of those regulatory requirements that, for example, you would do if you made an offer to investors for fundraising purposes, say, for example. But in order to comply with those, certain conditions must be met. Sometimes they're quite simple and it includes one or two lines in the offer documentation. Sometimes they're more complex, and that just turns to the structure of the award itself and how much an employee is or isn't paying under the plan. And it also turns on the seniority of the employees receiving the awards. The intention of the legislation is there just to protect employees and make sure that they understand the deal that they're getting themselves into, essentially. So when I mentioned previously that you could use equity awards as part of a REM package, so where there wasn't perhaps enough cash to bring in the sort of the talent or the employees that you're looking for, the legislation is there to ensure that such employees would have enough information about the company to say, all right, I'm agreeing to less cash bonus or no cash bonus, but I'll get equity, or I'm agreeing to salary that's a little bit less than I would have, but I know I'm getting this equity award. But have I got enough information to make sure that I understand what value I'm getting, and this company is not about to go under in the next 3 weeks, so that I know that it's solvent. I understand enough about this deal that I'm able to make that informed decision that yes, I'll accept these options. Even rights, the legislation says that it is kind of whilst you're not paying money and it's easier to comply with legal requirements for things like rights where it's for free. That when Treasury is drafting the new legislation, they were of the view, well, it's not for money, but it is for some consideration because you have to work, you have to remain employed to get the shares. So that's basically what those laws are aimed to do, without kind of going through those in detail in this session. And so it's important to comply with those, because you can end up in trouble if you don't and make an offer of shares without a prospectus and without a exemption from needing a prospectus. We have an EOA session coming up on the next one, so I'm not going to say too much other than all of those things are true in Australia. It can look very different where you've got employees in other jurisdictions. Even if you've got one person in one other country, they will have different tax and legal consequences. So it's really important to look at that up front and before you make any grants of awards, to get some tax and legal advice on what that looks like from the other jurisdiction. And as Sonia noticed, like for example, loan shares, they really don't work very well outside of Australia. So that's something you want to know sort of fairly on in the process. Next EOA seminar will give you more on that one, but it's really important because that is one that sometimes people just inadvertently miss, or they assume it's quite similar overseas, and it really can be very different. Next point on checking company documents, constitution, shareholders agreement. If we're going to be issuing new shares, we are diluting current shareholders. There might be some dilution limits in the shareholders agreement, or the shareholders agreement might talk about getting some sort of confirmation or agreement from existing shareholders. So we just want to be make sure we comply with anything like that. We also want to think about the fact that we're making these employees shareholders if they aren't already. So they might be required to sign up to the shareholders agreement, or we might have to amend or make a new shareholders agreement to allow for this new for these new shareholders to come in. It might be under our ordinary class of share. We might be making a sort of a separate B class of ordinary shares. And if so, what does the Constitution say about how we go about creating our new class of shares? And again, what does the shareholders agreement say about that as well? So just important to check those documents when we're doing anything with shares, and make sure that aligns and to see whether something needs updating. Clear employee comms goes to generally in the offer plan documentation. So you might have FAQs, things like that. The main thing to say there is in order for employees to value what you're giving them, so we've gone through all the process, we've picked what we think is going to be a great incentive for an employees, we've got our tax and legal advice, our plan documentation. We really want employees to value these awards. And what we find when employees don't value equity awards is they just don't understand them. And by not understanding them, they don't always understand how or when they're going to receive value. So if you don't understand when something will vest, if it will ever vest, how that value will be delivered, you can't really place much value on that. And so this is why it's quite important. Now, depending on the industry, if you're in an industry that is kind of in financial services, you might have quite savvy employees and they know, and that employee comms could be clear but quite concise. But you might also have employees who've never owned shares before and don't quite understand. And so in order for this to be an effective incentive and retention tool, they have to really understand the opportunity to get value, and how that could look for them. So it's really important so that all of this effort doesn't really fall flat. Often we do find companies will say, oh yeah, we've had this option plan for a while, but nobody really, no one understands it. Nobody gives, places any value on it. So it's just a real missed opportunity there. So that's really important. And the last thing to say is just to consider timeframes and linkage to company milestones and key dates. So when we're setting things like the vesting conditions and thinking about how long those might be, what how long will the vesting period be, how long will what are our time horizons for our business strategy, company milestones, how can we best link that into the vesting conditions? You might want to think about timing and how you can really link that through to what's happening in the business. Again, to have that real clear communication around what the vesting is, but also just to really align it and get that kind of same message across where we're headed and how these incentives are going to reward you as we head towards those milestones. That can also make it really effective as well, if that kind of makes sense to people and aligns with other messages that they're hearing. That helps to create value as well. So that's probably the last bit I'd say there. Do we have any questions? No, that was a bit of a
Um,
monologue from me.
Natalia, before we go into the questions, it's probably worth covering a point around sometimes when awards are granted, and usually options or rights, companies decide to include a discretion where they can cash out at their election. So they provide cash rather than settling in shares. And what that does is, for tax purposes, we call that indeterminate rights, whereby at the time of grant, those awards don't effectively fall within your employee share scheme rules. And so the timing keeps going until such time that I guess it's settled in cash, in which case, you see the tax implications are the same as what would be salary or wages. But to the extent the board decides at a further point in time that they are at that time settled in shares and it makes its decision at that point in time, you go back to the beginning and treat those awards as if they always fell within your employee share scheme rules. Um, sometimes that doesn't really matter, but effectively they are indeterminate rights and we need to analyze them for tax purposes. But where there is a difference is payroll tax. So with payroll tax, companies can decide whether they pay their payroll tax on these at grant or at vesting. But for indeterminate rights, that alternative doesn't exist. And so companies will then pay their payroll tax down the line when the board exercises that discretion. And so effectively, if you've got a share price that's going up, there may be, I guess, a cash difference there in respect of payroll tax. So I just wanted to mention that also, as we see that quite often.
Yeah, thanks, Sonia. It's a good point because you can often have discretion to settle in cash, and a lot of companies do like that flexibility.